to everyone that has entered the chat and everything. We're really excited about this particular Planned Giving webinar. We're excited to have the Planned Giving webinar series back and endorsed by Continue United. Continue United is an affinity group of the United Way of Greater Toledo. It's designed for retired or soon to be retired individuals who recognize the importance of philanthropy and the role that volunteerism plays in building and strengthening our community. If you'd like to learn more or join us, you can email me, Scott Schultz, at scott.schultz@unitedwaytoledo.org. So let's get on with the show. Today's presentation deals with tax law changes as it relates to the One Big Beautiful Bill passed in Congress last summer and the potential impact it might have for taxpayers. To help us guide through the changes, we are very happy to have Charlie Heid join us today. Charlie is a retired tax principal with Clifton Larson Allen, LLP. Over his 40-year career in public accounting, Charlie served clients in a wide variety of industries, including manufacturing, wholesale distribution, retail, and construction. So a lot of experience. His experience does include working with individuals, family-owned businesses, and multinational companies in a variety of areas, including multi-state and cross-border taxation issues, individual and corporate taxation, flow-through entity taxation, accounting methods, and transaction advisory services. Charlie, I know we have a lot to talk about today and a lot to cover, but we're thrilled to have you on board to guide us through.
Well, it's an honor to be here. And again, just thrilled I could help out.
Okay, let's get underway here.
All right.
Yours.
So let's just jump right into this. First of all, it's the perfect day to be talking about taxes. It's cold, it's dreary and gray outside, and that's how we all feel when it comes to taxes. So we're just going to jump right into this. HR 1, which is the tax bill that passed last July. I'm sure you've read a lot about it in the news. It went in on July 4th. It's often called the One Big Beautiful Bill Act. And there's a lot of things in this bill, and we are going to focus on the larger individual impacts today. Many of the provisions from this bill will take effect here with your 25 returns that you're just now getting ready to file. And a lot will come into effect starting in 2026. So that's important to know. And again, when it comes to some of these provisions, they're now permanent, which means that's great from at least a practitioner standpoint, is I can advise clients going forward because I know what the law is going to be. I don't have to worry about it sunsetting a year from now. So we got some permanency from the HR 1, which is great, and we're going to dive into some of that right now. So number one, the individual tax rates. So with HR 1, the rates that were in effect from the Tax Cuts and Jobs Act, which passed late 17, and we've been under those rules through 2025, those are now made permanent. So that's great. We know the tax brackets for individual income tax going forward. We're not going to revert back to where we were at pre Tax Cuts and Jobs Act. So we know we have a top bracket of 37% versus it was going to go back to 39.6. We also have lowered income taxes because they've spread the brackets out, and people are going to be paying lower taxes because for example, the 12% now encompass what before you might have been in the 15% bracket. So that's great news for all taxpayers. We also have an additional year of inflation adjustment for that 10 and 12% bracket, which came in with the HR 1, and that will be for the 2026 tax year. All right, so you're all familiar with the tax brackets, but I wanted to just share the married filing separate. So you can see, if you're a couple and your taxable income is over 751,600, you're paying in the 37% bracket. And you can see how everything is tiered going back to the lower brackets. And then we can jump to the single and we can get an idea on that. So there you can see on single, 626,350 is the threshold when you enter the top 37%. So again, I think it's great because the lower brackets have expanded. So more and more people are going to be paying in lower rates versus getting caught up into the higher rates. So I did want to talk about capital gains. A lot of people hear in the news, oh, if I have capital gains, I'm going to pay tax at 20%. Well, that's not true. We have, just like we do for ordinary income, we have marginal rates for capital gains. So if I'm married filing joint, I can have 0% capital gain rate or a 15%. And it's all based off what my income level is to determine what rate I'm paying. So the key here is if I'm married filing joint and my income is going to be above $600,050, that throws me into the 20% bracket. If I'm between 96.7 and 600,050, I'm paying 15%. If I'm below 96.7, 0% capital gains. I wanted to point this out because a number of people on this call may have trust out there. And trust are tax-paying entities. And as you can see here, if you've got a trust and it has taxable income, you get to the top bracket extremely quick. And that's important to know. And the reason I say that is working with the trustee, you may want to consider distributing income out of the trust to the beneficiary and let the beneficiary pay the tax. And as we just discussed, that beneficiary might be in a 24% bracket where the trust is already in the very top bracket for individuals. So just be aware of that. All right, now we're going to get into what I call the meat and potatoes of HR 1. So standard deductions for 2025. If you remember, the Tax Cuts and Jobs Act really doubled the standard deduction. And when that happened, almost 90% of U.S. tax returns filed today are not itemizing. They're taking the standard deduction. So for 25, the married filing joint would be $31,500. On top of that, if the individuals are 65 or older, they get an additional standard deduction on top of the 31,500, which I've referenced at the bottom. But it's important to know these have been made permanent. They will be indexed for inflation going forward. And more people are going to be taking the standard deduction versus itemized. So let's get into, there is a new deduction out there, the new additional senior deduction. So this kicks in for any taxpayers that are 65 or over this year in 2025. And you get a $6,000 additional deduction. And that is, if you itemize or standard, you get that $6,000 additional deduction. There's a new form out called Schedule A1, where this deduction is claimed. And there is an income phase out. So you can see if you're married filing joint and your income, your AGI is above 150,000, it's going to get a haircut. It's going to get reduced. If you're below that 150, you're going to get the full additional deduction. This deduction came into play to satisfy on the campaign trail when the president had said he didn't want to tax Social Security. Well, they couldn't address the Social Security because that would have involved passing a bill other than through reconciliation, which is how they got this tax bill passed. So they came up with this new additional senior deduction. And again, married taxpayers must file jointly to claim this deduction. So if you file married filing separate, you're going to lose out on this deduction. And this is only available 25 through 2028. Let's do a quick example. So we have Charlie and Lori both turned 65 and 25. Their AGI is 175,000. So their maximum deduction for this new additional senior deduction would be $12,000. But because their AGI is above the threshold of 150, the top end for married filing joint, they're going to take a haircut. So as we walk through the example, we've got the haircut calculated at $1,500. So instead of $12,000 deduction, they're only going to get $10,500. Now, state and local tax deduction, and I'm going to go back pre-Tax Cuts and Jobs Act. Maybe many of you on this call filed your returns and you were itemizing because you were able to claim a state and local income tax deduction on your 1040, along with maybe mortgage interest and charitable contributions. But there was no cap on SALT. Tax Cuts and Jobs Act capped our SALT deductions at $10,000. So if you're in Ohio and you have Ohio withholding on your wages, school district withholding, city income tax withholding, and you pay your property taxes, all of those would be deductible for federal income tax purposes. However, you were capped at 10. Well, they have removed the cap or increased the cap to 40,000. And this is for 2025, but there is an income phase out. So once your AGI is over 500,000, it is going to be reduced. But here's the key. It can never get reduced below the $10,000 that we already had. So just be aware this year, you might be looking at a higher state and local tax deduction if you itemize. So we had some new haircuts that came into play with this bill. And this one is going to take effect in 2026. And this is permanent. So going forward, it is going to always be out there. Now, when I say permanent, there's nothing permanent with our government. It's basically, it's permanent until another tax bill is passed. But right now, this is a permanent change. It's only going to affect taxpayers that are falling into the very top tax bracket, that 37%. And what they did is they have put in a haircut on your overall itemized deductions. So if you're in that top bracket, you're going to lose 2/37 of your total itemized deductions. If we jump to the next slide, I believe I have a quick example. So this would be typical. You've got an individual, they have $1 million of taxable income. That clearly puts them into the top bracket. They have mortgage interest, very common. They have some medical expenses that they've exceeded their threshold, and they have state and local taxes. In total, I add all that up, it's $34,500. Well, $34,500 would be the deduction in 25. Come 2026, when this new haircut applies, Alan is going to be limited to 32,635 in total itemized deduction. So he's losing 1,800 and change in itemized deductions. So then we also, I think this is fantastic. I'm thrilled about this first one. HR1 did make a permanent change related to charitable contributions. And this has to do with those taxpayers that take the standard deduction, which, as I said earlier, 90% of taxpayers claim the standard deduction today. They got no benefit from donating to charities. Well, if you remember back when the Tax Cuts and Jobs Act passed, they threw in a $300 for single, $600 for married filing joint, where you could deduct up to that amount and claim the standard deduction. Well, that went away because it was only for 2020 and 2021. This came into play starting in 26, and it is permanent. And so as a single taxpayer, I can deduct 1,000. Married filing joint, I can deduct up to 2,000 in cash charitable donations. So just be aware of that. Going forward in 26, you're going to want to start keeping track of your receipts.
We're well aware of this one, Charlie.
Yeah, there you go. Yes. And I think, and it's great policy. It is great policy. Now, the next one, there is a new haircut. It's 0.5% that kicks in starting in 2026. And this is a floor that never existed in tax law until the passage of HR1. And what this simply says is you get no charitable deduction unless you've exceeded 0.5% of your AGI. We always have had a ceiling, which everybody's been familiar with. And that ceiling was you were limited in the year to, you could only deduct up to 60% of your adjusted gross income. And anything above that limit was carried forward. Well, now they put a floor in. And if you go to the next slide, here's a quick example of how this works. So you've got, if I have $1 million of AGI, my floor is $5,000. Well, if I've only given $4,900 in gifts, I have no charitable deduction this year. And that's just the product of this haircut. If I give $5,100, I get to deduct $100 and I lose the $5,000. And in case of if I give $605,000, my deduction is going to be $600,000 and I have a $5,000 carryover. So tip income. We all heard about this, tip income, overtime. So let's just kind of dive into what's involved with the tip income deduction. So this is a temporary deduction. It only exists for 2025 through 2028. It's going to be up to $25,000 per return. Married filing joint is required to claim this deduction. For qualified tips. Now, tips must be paid to workers customarily and regularly receiving tips. And we're going to cover that in a second. They must be paid voluntarily without negotiation, not received in a specified service trade or business. And what I mean by not without negotiation. So we've all been in cases, we go into a restaurant and there's a mandatory 20% gratuity because of the size of our party. That tip will not be considered qualified tip income. There is a phase out, income phase out on this, and it's available whether you itemize or claim the standard deduction. So here is how the Treasury has defined who is eligible for tip income deduction. So beverage and food service, no surprise. Entertainment and events, hospitality, guest services. You have to fall in one of these 8 categories, and your employer will identify you, and they will be required starting in 26 to report this info on your W-2. For 25, they're supposed to give their best effort to provide the employee with this information to claim the tip income deduction. Overtime income. This was, again, right along with tip. This was a big one. It is a temporary deduction. It's going to be up to $12,500 for single, $25,000 for married filing joint. And the definition of qualified overtime income is under the Fair Labor Act of 1938. So when you think about it, we've all heard of time and a half. It's the half portion that is going to be the qualified income that you'll calculate your deduction on. It's not the time and a half, it's the half. The employer is required to provide the employee with that income. For 25, any reasonable method may be used. Beginning in 26, there is a new W-2 form that has new fields that this will be reported on. There is an income phase out on this. This is another one that came in. So you had tip, you had overtime, then we had new car loan interest deduction. So this is basically, you have a car, you use it for personal purposes, you borrowed money to buy that vehicle, which we've all done. Well, that's personal interest, which has never been deductible in the past. Well, now through 2028, it's temporarily allowed as a deduction, provided you meet these requirements. And that is, you're limited to $10,000 per year per taxpayer. There is an income phase out to this. I can claim this whether I take the standard deduction or I'm itemizing. Now, the conditions are the debt must be incurred after 2024. So it has to be new debt in 25, must be secured by a lien on that vehicle, and the vehicle must have been assembled in the United States. Now, a lot of you might say, well, how do I know that? Well, you can go out to the IRS website, the VIN that you're going to be required to put on the form, you can enter that VIN into a database on Treasury's website, and it will tell you if that vehicle was final assembled in the US. Some other provisions that I just wanted to talk about. So Trump accounts, we've all heard of these. This is something brand new. It got a lot of press because when Trump accounts were passed in HR 1, children that are born in 25 through 2028, the federal government is going to seed these accounts with $1,000 per beneficiary. So that's huge. You've got the government who is putting $1,000 into these accounts. Essentially, the Trump account is going to be like a traditional IRA. The contributions can be made for the beneficiary up until that beneficiary turns 18, at which point this Trump account essentially converts to a traditional IRA for the beneficiary. Contributions could not be made in 25. 26, beginning July 4th of 2026 is when contributions may be made. Now, there's still a lot of information coming out on Trump accounts. Treasury has just released a Rev Proc on these recently. But what we do know is you're going to be capped at a $5,000 contribution. Anyone can make it. Parents can make it for their kids. Grandparents can make it for the kids. Friends can make it for the kids of their friends. An employer can contribute to this for an employee, and it's not taxable income to the employee. So there's a lot of talk on these accounts. But I think the biggest thing is if you've got a child, a grandchild that was born in 25 through the end of 28, they should have a Trump account because you have $1,000 of seed money coming from the federal government that's not taxable when they put it in. So on estate and gift, I just wanted to point out, so Tax Cuts and Jobs Act dramatically increased the lifetime exemption that we all have as far as would I be subject to my estate being taxable by the federal government. And that was 13,990,000. That has been increased to 15 million for 26, and it's subject to inflation going forward. So we have, excuse me, permanency on this, which is something that we didn't have until the passage of HR 1. Now, I did want to close with electronic payment, and I'm going to use myself. I think most of us probably, when we file our returns, we electronically file. We've probably taken advantage of direct deposit because we get our money back on refunds much quicker. But if we owed, we might have been mailing checks. So this is something that is going to be unfolding over the next, started really late in 25. It's going to unfold more as we go into 26. But Treasury, there was an executive order issued March of 25, basically saying the US government would no longer be issuing paper checks or accepting paper checks. Well, that's tough because there's a lot of people out there in groups that that's not an option. They don't have the ability to issue a paper check or receive. So there's been slow guidance that has rolled out. The refunds definitely are going out electronically. And there's guidance out there if somebody doesn't have a bank account, ways to get a bank account set up so you can receive your tax payments electronically. You can still mail in checks, but I want to make you aware that you need to really embrace using direct pay out on the IRS website where you can do an ACH transaction because it is coming. There's going to be a point where you will no longer be able to write a check and mail it to Treasury.
Hey, Charlie, I wanted to jump in with something here. You look at opportunities to have folks, become a little more financially stable. One example we have is we have a program called Ride United, which is a tremendous program that allows people to have access to transportation otherwise couldn't have it. And donations to United Way's Ride United program, as the slide says, helps to make it easier for people to get to the offices where they can obtain the documents they need to file their taxes, as well as to banks where they can open up accounts required for the process. Just a really great value add that we provide the community at United Way.
That's great. And I'm thrilled that you're encouraging people to have